Hey everyone, and welcome back to another video for today. In today's video, we have to look at what the market gives us on this fine Monday morning. We'll talk about the Nebius Meta deal, and then we'll talk about a particular company, a particular stock that is so cheap that we could say this is like Meta in 2022, or maybe even Google mid-2025. Right now, when you look at the heat map, beautiful Monday morning or afternoon, depending on where you are. Beautiful green across the board. If you're colorblind, well, it probably looks the same to you, but it's green across the board. We like to see that. We see Micron up 5.4%, Intel almost 5%, Nvidia is up 2.1%, Meta is up 3% on, of course, the rumors that it might or might not lay off 20% of its workforce. Maybe it's also because of Nebius. Who knows? All the big tech companies that we follow here are green. If you look at the fintech names, most of them are green as well. Only Dave, Adyen, and Klarna are red. NeoClouds, Nebius is up 13.2% today. Iron is up 6.5%. The rest was also up today on Monday. And so what exactly has happened and what company am I talking about? Well, I'm talking about Meta. Yes, Meta is the Meta of 2022. So we'll talk about the company right now. We'll talk about the sentiment around the name. I'll show you a valuation model, bear case, bull case, and base case. You'll see the differences in price targets. And of course, we have to talk about the Meta and Nebius deal. So if you enjoy these type of videos, of course, hit all the buttons. We'd really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So Meta right now is up 3.2%. We can see what has happened in 2022. Now, I know, to say that this is like Meta in 2022 is maybe a bit cliche or thing. Okay, I understand, because back then, as you can see, Meta was down 70%. But since that bottom, well, it's up over 500%. Now, over the past 12 months, right now, it's only up 4.7%, and year to date, it's only up 2.7%. This is a company, if you look at it right here, it's a company worth $1.5 trillion. Margins pretty good. Of course, margins, especially free cash flow margin, are coming down because of a huge increase in capex. Trailing 12 months PE, 26.1 times. Forward one, 20.3 times. Yes, price to free cash flow is, of course, extremely high. Now, on this whole capex story, we will talk about that, the multiple scenarios, the reports that came out, etc., etc. But before doing so, let's try to understand why Meta is taking a hit. And to understand that, of course, you can go to fiscal.ai. There's a link down in the description, and in the pinned comment, you'll get 15% off. New users will get to use Fiscal Pro for free for the first 2 weeks. And now with the amazing grid view, you can actually put all of the margin profiles that you want, one next to the other, one under the other here. So what do we have? These are last 12 months, so you get a better picture of the pattern and the trajectory. So operating margin, 41.4% over the past 12 months, still very good. Small reminder that at the bottom, 2022, well, it was last 12 months, so you see here March 2023, it was 23.5%. We're still far, far away from that. Then free cash flow margin, right now close to 23%. The bottom was 15.19%. Gross profit margin, right now 82%, back then close to 78%. Moving on here, net profit margin is now at 30%, but you will see that this is just because of a one-time impact. I believe it was 2 quarters or so ago. But even with that, we are still far away from the 18.2% a couple of years ago. Same thing here, EBITDA margin 50.7%. The lowest point was 31.2%. And here you can see the one-time impact on net profit margin that was 5.2% 2 quarters ago, which is why it impacted the last 12 months one. Last quarter, we had 38%. The June quarter was 38.5%. Now, when we look at some pricing metrics, so forward PE, forward price to sale, trailing PE, and price to free cash flow, also trailing one, we can see the following thing. Back here at the bottom, right, this is like Meta 2022, but Meta 2022, as you can see, the forward PE was closer to 12.5 times. The trailing PE was also very, very low back then. But then, yeah, you can see a huge increase, and suddenly it reached a PE of 35 times because, well, again, this is the trailing PE, so it takes that negative impact. The forward one is taking the forward-looking positive impact in this case, but that was 12.7 times, whereas right now we're still sitting here close to 21 times. What else did change? Well, price to sales, 2 times. Right now, still 6 times. What was also better back then, because the CapEx story, the huge CapEx story did not start in 2021, 2022. So price to free cash flow was also very, very reasonable, close to 9 times. Today, of course, on a trading basis is 33.6 times. On a forward one is much, much higher because of the CapEx. And that's the problem right now. It's all of the investments that we're seeing in Meta, or shall I say by Meta, what's going to be the return on investment? How much value can they extract from all of these expenses, from that huge CapEx increase? How much free cash flow are they going to be able to generate? How much profit will they generate in the future? You will see in the DCF, you will see that most of the value does not come from the first couple of years. No, it comes from everything afterwards, because you will see that free cash flow to the firm is going to be, or expected to be, negative for the next coming years. Right now, if we actually look at free cash flow for 2026, it's expected to hit a low point here of $10.7 billion. That's still $10.7 billion of free cash flow, and it's expected to rebound afterwards. Now, we know that CapEx is expected to almost double in 2026. Some companies like Amazon, people are expecting free cash flow to be 0 or even negative in 2026. Now with Meta specifically, we've already heard a couple of rumors and reports that, one, they're planning sweeping layoffs as AI costs mount that could affect 20% or more of the company, although a Meta spokesperson said that this is speculative reporting about theoretical approaches. Okay, remains to be seen what happens with that. What we've also heard is this: the Avocado LLM delay. So the next-gen model delayed from March to at least May because it falls short of Google Gemini 3.0 and reasoning coding benchmarks. It beat their own Llama 4 and outperformed Gemini 2.5, but didn't reach frontier level. Okay, we'll see what happens with that. Of course, they are spending an insane amount of money, but what happens if they cannot come out with a state-of-the-art model? Maybe, yes, maybe licensing Gemini is going to be the better approach. If that happens, then yes, naturally we would say CapEx might actually come down a little bit and free cash flow will rebound much faster than initially anticipated. As for the next step, how can they become even more profitable? Well, in-house chips. They announced 4 new MTIA chips, 300, 400, 450, and 500. They expect new chip every 6 months. Now, the MTIA 300 is already deployed. The 400 is shipping this year with full liquid-cooled rack systems. Of course, a big winner here is Broadcom. Now, this again, the bull counter argument would be that, yeah, maybe they'll spend an insane amount of money on NVIDIA's chips, but what if after a couple of years they can balance it out? In-house chips for them, the margins are going to look much, much better. And so suddenly the return on investment looks better for the company. It's definitely possible. But the thing right now with Meta is companies spending an insane amount of money on this infrastructure, building data center, GPUs. Right now, their AI model is definitely not the best one out there, despite them telling us that Meta's AI has 1 billion monthly active users or whatever. I would probably say that most of them have just used it by mistake because it's part of search and in WhatsApp and things like that. Okay, but for now, I'm yet to meet one person that thinks that this is a good product. What could accelerate the adoption is, of course, the continued success in AI hardware, right? The Meta glasses, the smart glasses. If that, of course, gets even more traction, which for now it has been extremely successful. Of course, Reality Labs is a money-burning machine. But if those hardware products do become more mainstream, and that is powered by Meta AI, then yes, I do think that eventually you're going to see broader adoption of Meta's own AI models. Now, before going and looking at the DCF, remember back in late 2025, we've had, of course, the first agreement between Nebius and Meta, a $3 billion agreement. we knew that this number could have been much, much larger if Nebius had the capacity, if they had more to give. Well, we also said more recently that I do believe that the next deal is probably going to be another Meta deal. It didn't take that long until we got confirmation, because that's exactly what has happened earlier today. Nebius signs new AI infrastructure agreement with Meta, deal to accelerate growth of Nebius core business in AI cloud. I've already seen some people say, oh, but I don't understand this part of the deal. What is this, blah, blah, blah. Well, just read. It's very, very easy to understand. If you don't understand this, this is basically this. Under the 5-year agreement, Nebius will provide $12 billion of dedicated capacity across multiple locations. Based on one of the first large-scale deployment of NVIDIA Vera Rubin platform, Nebius will deliver this capacity starting early 2027, which is why the 2026 guidance remains unchanged. Then, in connection with access to these NVIDIA Vera Rubin deployments, Meta has committed to purchase additional available compute capacity across certain upcoming Nebius clusters up to a total, so again, it's up to a total of $15 billion over a 5-year period. Nebius currently intends to sell this capacity to third-party customers of its AI cloud business, with remaining capacity to be purchased by Meta. So yes, the big number here, when you will see the headlines, it says $27 billion, which should probably say up to $27 billion. And this goes back to what Nebius has told us before. This goes back to what Oracle has told us as well, prepayments. Prepayments allows these types of companies, of course, to burn way less money, because you get the prepayment, you can already invest that in the business today. You're securing a lot of capacity, a lot of build out with money from customers, not from your own company that's already burning quite a lot of money. To me, the fact that we're seeing yet another huge deal for Nebius just confirms what we've been saying from the start. Nebius is best in class. As Arkady says here, we will continue to deliver. Moving on to the DCF valuation here for Meta, a bull case, base case, and a bear case. If you just want the overview, this is basically it, or maybe even the conclusion is a little bit better. So maybe I'll start with that and then I'll explain the whole story. So we look at the probability weighted valuation. I put 25% on the bull case, 50% on the base case, and 25% on the bear case, which gives us approximately $844.74, which is close to 34% upside from the price we're at right now when you look at the probability weighted upside and downside. And so how do we reach those numbers? Well, the bull case is, of course, the most bullish one, and you don't have to agree with those numbers. I'm still trying to figure out how I can share all of these Excel sheets so you can play around with those numbers. We'll see how we'll make that work. There's no Patreon or anything like that. So if you're getting messages from a couch investor on WhatsApp or Instagram or whatever, trying to sell you anything, it's not me. So a bull case, we see here 105.3% upside from the price we're at right now. The revenue rate is pretty simple. The first couple of years here, I'm basically going to be a little bit more bullish than what Wall Street is. And then yes, the growth rates are coming down slowly but surely. At the end of the period sits at 7.3%, and then terminal growth rate sits at 3.5%. As for EBIT margin, this is basically it, 45%. Terminal number here at 44%, tax rate at 14%. And here you can see that 2026 is the year where free cash flow to the firm is going to be negative, the biggest hit right here. And already in 2027, we see it rebound. That, of course, has a huge impact on this part of the model, because if you look at the base case, for example, here as well, revenue growth, things like that, I'm taking the first couple of years, basically what Wall Street is doing, and then we're going down a little bit afterwards each and every year. Terminal growth value 3%, 40% EBIT margin. But here, as you can see, if we go to free cash flow to the firm, you can see that the first 2 years here, it's going to be negative, and only in 2028 do we see a nice rebound, which means the upside that I'm seeing here is 26.1% on the base case. Moving on to the bear case, here also with being bearish, you don't have to throw suddenly, oh, the market is expecting, or even the company is expecting to grow 24%, but because this is the bearish case, I'm only doing 10%. No, it still needs to be realistic, which is why you can see that the expected revenue growth rates for the first couple of years are still very, very realistic. It just goes down much faster afterwards, and the terminal growth rate is 2.5%, EBIT margin 37%, so we do see some deterioration there in margin, but here as well, you can see, first of all, CapEx is going to continue to increase quite a lot. And here you can see that the free cash flow to the firm is going to be negative up until 2029. Of course, that has a huge effect here on this part of the model, because with the bearish case, and even with the other ones as well, you get most of the value from the later stages, which means, yes, we expect the company to know what they're doing. We expect the company to say, you know what, we're investing a lot right now, but we do think that the return on investment is going to be a pretty good one, which is why we're making these assumptions, which is why we're reaching these types of numbers. Now, with these types of numbers, a bearish case, we can actually see 22.1% downside from the price we're at right now. And I do think that it's a pretty good range. It could maybe improve a little bit, but at least here you see the risks of, well, the roadmap for Meta. What if they don't monetize correctly? Well, then you see here 22.1% downside. And so again, this is the conclusion for me with regards to Meta. I still view this as an excellent opportunity right now out there, especially if you want big tech companies that are very profitable, that are going to generate billions and billions of dollars in free cash flow in the future once this huge investment cycle is over. Meta is probably the one. Before we end this video, we see that oil is down 4.8% today, back to close to $94. We have the next FOMC meeting in around 2 days, and of course don't expect a rate cut, but do expect the market to move based on the Fed chair, well, Jerome Powell's comments on the economy and the way or what they're seeing in the data. And so right now, when we look at Meta here on the daily, we are still a little bit in no man's land under the moving averages here, but you can say that it is making higher lows. We went all the way down to around 580, then the other low is a bit higher here at around 600, and now it's even a little bit higher at around $610. To the chart professionals, let us know what you think about this in the comments. And so all in all, that's about it for me in today's video. Let me know what you think about Meta at current prices, what you think about the Nebius news. Do you want me to show you more DCFs on bigger companies, a Microsoft, and Nvidia, things like that? Let me know down in the comment section below. Don't forget to check out fiscal.ai. We'll see each other in the next one. Bye-bye.